classical, overeducated, and definitely underpaid guys. I was privileged enough to go to Mayo College, one of the premier schools in India, based in Ajmer. Very few people land up in IIT from there. Got lucky, was at IIT, but just barely above sea level. Luckily, I was a naval architect, so sea level was fine for me. Not smart enough or clever enough to go abroad those days, so landed up at IIM Bangalore from there. Learned a lot about networking, all the pubs in Bangalore in those good old days. From there, I started my career selling thread, as my father, bless his soul, used to say in Hindi, dhaga bechta hai. Right after all this IIT, IIM, all these degrees, start selling thread at Coats India. From there, moved to Standard Chartered, sold credit cards sometime, then moved to Capital One. Some of the people who are from the US or know Capital One, I was actually based in South Africa with them. They had a joint venture with Old Mutual. Spent time there, and then I moved to Old Mutual, which is the parent company. The JV broke up. I spent quite a bit of time, about 7-8 years with that company. Old Mutual helped me learn a lot about asset management. I came back to India in 2008. From 2000 to 2008, I was in South Africa. In 2008, I came back to India to set up an asset management company. So we'd applied for a mutual fund license. We'd appointed a CEO. We were putting up a wealth management platform. We were putting up a PMS, which is a portfolio management service business. But unfortunately, the Lehman Brothers fiasco happened. So we had to shut that down. So I became footloose and fancy free for about a year. And then, it's serendipity. So I'm an accidental entrepreneur. I am, I think, amongst the unique people in the country or the world who has two ongoing startups, both funded by leading investors in the country, in the world. So Axel Partners is a VC in both Probe and Scripbox. Probe basically has digitized information on any and every company in India, which is basically private limited companies. All the banks are our customers. So basically, if you want to understand the financials, legal history, directorship, shareholding of any company ever registered in India, you will log on to a product called Probe 42. The other business, which I will talk about a little bit more, which is Scripbox, which we set up about 10 years ago now, with the explicit idea that how do we bring the power of digital to wealth management. Digital for us is not about online. Digital app for us is actually about the science, the math, the data, the algorithms, the technology, the scalability, the automation, which digital brings to you, right? So it's like comparing Amazon with Big Bazaar Online. Right, that's the philosophy we bring to Scripbox. We're by our DNA, a digital company. We do have people on the ground. We do have relationship managers. This is not so much about Scripbox. There will be a bit at the end of it. I hope to cover a few topics. A quick one, and this will sound like motherhood and apple pie. Why you should be investing. So what are we really fighting for? And if you can see the slide and if you can see the numbers, this is a bill for fuel or petrol from the year of the Lord 1963, which is about 60 years ago, right? And the price is ₹3.60 for 5 liters of petrol. So obviously the math people will tell you 72 paisa per liter. Now, why am I telling you this, right? So what is the inflation for 72 rupees, 72 paisa to 108? It's actually only 8.5%. It looks like a really large amount. And if you continued with this inflation, right? Typically run this as a quiz, but this is not an interactive session. The relevant number would be 1,200 rupees, right? At the same CAGR. So people need to know that inflation is real and inflation is our common enemy. Because petrol is designated obviously in dollar prices very often, we really don't have control on this. Yes, electrical vehicle has come, but there's just an indication of how inflation eats into your money. Inflation eats into whoever you are, whatever you are. But I mean, again, this is a very simplistic slide. Compounding is our friend, right? The longer the term, the longer the interest rates, just the amount, the longer the return you can garner, you have a friend in your side. So don't take the easy path of fixed deposits or what have you. There are better avenues to return. And it's really important that you realize that why compounding is so interesting in the long term, because we are all going to live longer, right? This shows you that even in India, the average lifespan has gone from something like 54 to about 71, 72 now, in spite of the COVID dip, and expected to go to 80. But what this slide hides, and I think the IITians here will enjoy that, is that the older you are, the longer your chances of living, right? Because this obviously is an average. This includes all the children and the mortality of the younger crowd and everything else. So you can, next time I'll probably share that you can actually do a cohort analysis in which will tell you that the 40s and 50s will probably live to 90, right? And hence, if you plan to retire at 45 or 55, your money has to survive 40, 50 years, right? More people are scared. I mean, one of the questions which was done was, which is your biggest fear? And it was not dying. It was actually having no money at the end when you're close to death, right? And what's really important is that all the science efforts, and I know some of the guys here on the call or guys and girls will be working on biotechnology to help us live longer. So keeping this in mind, while we worry about our health and look after that, we also need to worry about our wealth. Obviously, this has nothing to do with the political dispensation. This is just about the India story, right? It doesn't matter who's the current government, who's the next government. It's just that India is an absolutely phenomenal growth story, right? Whether it is the largest, among the largest growing, fastest growing economies, whether you believe the data or not, it is a high growth economy. You look at the restaurants, you look at the airports, you look at the ports, you look at the railway stations. Yes, there is some disparity, but overall, it's a large growing economy and will continue to grow for many years to come. We have a demographic dividend. We need to take advantage of it compared to China very, very clearly, both on the production side and the consumption side. We have some time and another decade away before this peaks, right? So we have a great few years ahead of us, and it's important that we take advantage of this. Obviously, there have been lots of reforms in the recent past over the last 10, 15 years. GST formalized the economy. I mean, the GST collections keep going up year on year. It creates one nation, one market. I mean, as an example, my wife is an entrepreneur, runs her own design studio, and can do business anywhere in the country, right? And it's easy to do it. The ease of doing business, whether it's eliminating black money, whether it is about making it simpler, the IBC, which is the NCLT, the India stack, right? The whole Jandhan, Aadhaar, mobile, all put together has really opened up the economy for a lot of people. And you add that, and you add UPI, right? It's basically making consumption so much easier, and money multiplies, right? The more it gets consumed, the faster the economy grows. So all of these pieces combined with a lot of investment in infrastructure. As they say, roads are the modern rivers. If you remember, historically, all the larger civilizations were built around rivers. Now civilizations are built around highways. And I think India is investing very heavily in this. We have a dedicated freight corridor, which will obviously bring down transit time, bring down cost. We've seen lots of investment in modern airports and ports. You've heard all of this, but all I'm trying to emphasize is that it's really important to invest. And India is a great country. And I think Nishani mentioned this at the very beginning. Some of the people who are dialing in are probably living abroad. So not having India as part of your portfolio is not ideal. So investing in India is a good idea. And India has provided great returns. Volatile at times, but if I take the last 30 years, we have had returns of 10.5% on the CAGR basis. This is Sensex. If you continue this way, I mean, this 20,000 rupees will become 3,69,000, right? That's a lot of money, right? So in terms of compounding. So the India growth story is intact and will continue to grow and compound from here. Now, that's sort of motherhood on apple pie and very generic. What is it about you? Again, this is a simple slide, but talks about a lot. So what can you control, right, in creating your wealth? It's how much are you investing? Obviously, very obviously. You multiply that with the rate of return, right? The higher amount of risk you're ready to take, but what really makes it powerful is how long do you let it compound, right? So it's all three you need to get right, and you need to, and the ones you can actually manage most is saving up more so you can invest more. So wealth creation is as much about investing as about saving, right? So you consume less at some point, and you put aside more money, and you keep investing and keep it invested for the longer term. I can't overemphasize this. A lot of people are chasing returns in investing, but wealth management tells you that the principal invested and the number of years are far more important than the rate of return. Some theory, obviously, there are multiple asset classes. Let me spend a couple of minutes on this slide. There's your savings account, which is the safest. Is your fixed deposit or term deposits. There are money market funds. There are corporate bonds. There are government bonds. There are balanced funds. There's large cap equity. If you want, I can spend a minute on these. They are just different asset classes. I've not included real estate or gold, but basically there are multiple asset classes which have their own risk and return profile over time. The rightmost is private equity venture capital. I'll spend a minute on something called startup investing. One of the flavors of everybody, and I'm sure some of the people on the call talk about angel investing, and I've seen a few webinars arranged on that. Our belief is that startup investing or any of these as a part of your portfolio should be at a maximum 5 to 10% of your overall portfolio, right? And I'll come back and touch on this topic as to why and how much should you be investing in this. Right? A typical asset class like startup investing requires a 10 to 12 year horizon with a very high risk appetite, right? And the appetite to keep on investing in that asset class for at least 3 to 5 years before you see any returns in this particular category. I think this is a classical IITian slide. So while there's a risk return profile, also remember that classical, I've obviously turned the normal distribution curve, that the spread of negative and positive returns at each risk level are substantially higher. So there's a very fair chance that if you're not in it for the long term, right, if you don't wait for the median, you will experience some really, really low returns over time. So having the appetite for the right asset class for the right reason is really, really important in each of these categories, right? So whether you are investing in money market instruments, or whether for the next, say, your requirements for the next 1 year, whether you are investing in sort of startup investing for money you need in 20 years from now, is up to you. But having visibility of this, and obviously there's a lot more data behind all of this, which gives you a sense of what you can expect for each of these asset classes. Now, this is a very busy slide, so I will spend a minute on this. And I apologize for it being so busy and colorful. And in spite of my best efforts, I couldn't improve it. What this is showing is that there is no perennial winner. If what the x-axis is showing is time, the y-axis is showing multiple asset classes, and what is right on top is the winning asset class in that particular year, right? In that calendar year. So in any calendar year, you have no idea what's going to win. And there is no perennial winner, right? So real estate was 7.5% in this is all India data, 7.5% in 2013, gave you 9.6% in 2016, and has dropped down lower. Something like a mid-cap index, the blue one was a rock star in 2014. Again, a rock star in 2021, but absolutely down in the dumps in a different period. So while you're constructing your portfolio, it's very, very important that you're able to blend asset classes so that which are uncorrelated assets, right? Say maybe gold and equity are uncorrelated at a certain level, or Indian investments and US investments. And I can spend a lot more time in a separate session around each of these asset classes and their relative correlations. But if you blend it, I'm giving simple theory so that I don't know the breadth of the audience, that if you pull it together, you're able to get a much better risk-weighted sort of portfolio over time, right? So that's the basic theory of asset allocation, that multiple asset classes have different return profiles, very often unrelated, and there is nobody can tell you exactly what's going to happen in the future. You obviously in the long term, you can have a view. So combining these asset classes does help with your portfolio. Obviously, simplifying it to the nth level, have a solidity in your bond-based portfolio or your fixed income or principal protected portfolios, and take some risk on the rest of your portfolio so that you can grow your wealth over time. Again, asset allocation is not only a theoretical exercise, which the experts will tell you from the outside in. It's also the inside out, right? What are you investing for? Are you investing for your children's education 5 years from now? In 10 years from now? Are you investing for the next 20 years? Are you investing for the 30 years? Are you investing for your retirement? Are you 55 and you need the money when you're 65? What's your risk profile? And risk profile is a combination of risk appetite and risk attitude, right? Risk appetite is if you've got, your requirements are say 2 crores and your total net worth is 1 crore and you want to bet it all because you got the attitude into high risk stock, we'll tell you not to, right? So risk appetite is how much can you actually afford to take risk, and risk attitude is your own. Some people like to sleep easy at night and say, I'll put all my money in fixed deposits, which we advise against. But it's this combination which determines your asset allocation and obviously your financial circumstances, right? How long term is long term, etc. So basically, theoretically, pay a lot of attention to asset allocation and not returns as the only thing. Things will go wrong, right? If you look at the Sensex, we look at volatility all the time. They always do, right? So if you look from 1990, we've had the Harshad Mehta run, we had Ketan Parekh, we had the tech boom and things went up, and this looks flat now. But if you were in that moment, you saw 40-50% gain in that little time. The US subprime crisis sort of wiped out a lot of the money, but it came back. And I'll show you a slide. All I'm trying to indicate is that in the short term, there are large impacts, but in the long term, what seems earth-shattering not so long ago is actually a mere blip in the charts in the long term. Right? Again, demonstrate the same thing. If you look at the daily volatility over the last, say, 25, 27 years or 37 years, the daily volatility is just like as a squiggle graph, right? And if you make it monthly, make it yearly, and the moment you move to a 10-year graph, and these are 10-year rolling returns, right? It clearly shows that, yeah, it doesn't really matter in the long term, that the biggest enemies of investing are fear and greed, right? So if you're fearful and you say, okay, is the market too hot? Should I exit today? That's the question I get asked most often. Atul, is this a good time to be investing? Is this a good time to be withdrawing? And I always show this graph. I said, depends on what you're looking for, right? Yeah, if you want to think 10 years from now, doesn't matter. Yeah, put the money in. The thing I was talking about, right? If you, in the moment, for each of these instances, the decline in the immediate was massive, right? Shock to your system. The dot-com bubble, 50%. The COVID crash, 38%. Now, if I take Nifty 50 total return index, which includes the cost, if you had put in the money at the peak before the bubble. So I'll repeat what I said. The peak before the bubble, if you put in a lump sum, the CAGR today in 2021, this is just December 21 data, just for demonstration purposes, is actually very positive. So while it looked like all hell had broken loose and you'd lose all your money, even if you had put in money at the top, if you just waited long enough, it'll sort itself out. And then there's this whole question about timing the market, time in the market. Whether, and this is a SIP, which you're putting in every month, right? 10,000 rupees. There's a lot of noise around, should I put it in the first of the month, 5th of the month, 10th of the month, last of the month? Doesn't really matter. As long as you're investing for the long term and you keep investing, it really doesn't matter too much, right? The whole idea is just be there and stay invested all the time. Again, I've repeated myself. The longer the horizon, the lower the risk, but not too much delta and return. So just spending 2 minutes on this, the 3-year return, while it is 14.5%, and this over a 30-year rolling average, the range is from 0.5 to 28.5. So it's very likely that you could have had no returns, right? Because you got caught on the wrong cycle. Now you take the same thing to 20 years, right? The deviation is only 1.8%, right? So even if you did very badly, you'd be at 12.6%. And after 10 years, it becomes very steady, right? 11 to 12.9. So this is the Indian stock market. And obviously, we've seen so many booms and busts and so many cycles. So in a rolling average, if you just stay invested for the long enough in equity for a certain part of your portfolio, they're the likely returns you are likely to see. Now, okay, this is theory. This is for other people to believe. What about me, right? This is probably my favorite slide. The biggest, what should I say? I'm not talking about AI or chat GPT and these computer generated algorithm and portfolios. Like financial choices are like going to your doctor, right? For mild things, you'll pop a paracetamol or a Dolo or an Advil. But the moment you get slightly more serious, right, about life, you better find a specialist. And this is not to pitch, or maybe it is to pitch people like us, but you need to, if you need to learn swimming, you need a good coach. Similarly, you need, the way we describe ourselves is both a seat belt and a co-driver. Our job is to make sure you don't crash. Our job is to make sure that you're headed in the right direction. The driving is still yours. It's your money, right? So the important part is that when we look at money, there are three kinds of money. There is unmanaged money, there is self-managed money, and there is managed money. The dangerous part in our view, and this is with respect to, without any disrespect to anybody on the call, is self-managed, right? They sort of seem to know everything and are trying to second guess you all the time. The unmanaged is still safer, right? People are putting all their money in fixed deposits or not bothering about it. That at least you can change to managed money and hopefully give you better outcomes. But the self-managed is probably the most dangerous. There are exceptions to the rule, but broadly, our belief is that having somebody by your side is an important part. Again, all of us will go through this. Three phases of investing. Accumulation, when you're putting money aside, you're 40, between sort of 30 to 35 to 55 is our typical experience. Obviously, there are exceptions to every rule. When you are putting money aside, right? And while this is accumulating, you're also growing it. Beyond 70, 75, when you're not putting too much more into the corpus, it's withdrawal, right? And for each stage, you require for different products. And luckily, the Indian markets provide you that. Wealth creation has a suite of products available to you, from equity mutual funds to more structured products. There are obviously wealth protection. So as important as it is to grow your wealth, it is also important to protect it, right? The largest sort of killers of wealth are obviously health, any leery like COVID taught us, or life, right? Or your house burning down. So making sure that you're sufficiently insured across every risk category is really important. And obviously, in part of your portfolio, in the wealth preservation time, you need to have different products. Again, depending on whether you're looking at the stage of your life or the time horizon of your investments. Luckily, again, as I said, the industry provides you sufficient breadth and width and depth of products. But the question is, how does a layman investor really make sense of all of this, right? Should I put money into long-term bonds? Should I put money into equity, hybrid, conservative funds? So I don't like jargon, but just to demonstrate the point, I have led this slide in that, hey, this is all large words and what do they mean? So what we did at Scripbox was try to simplify all of this, right? So whole philosophy at Scripbox was, how do we combine the power of all of this knowledge, digital and simplicity, to make it simple for the investor? Because what the investor really is worried about is their children going to college, retiring safely, sleeping easy, having enough money, or having as much money as they need. And as I say, enough is a state of mind. So what do we do at Scripbox? And this is not a sales pitch. I apologize. I'll do a sales pitch later. What we do is we start with understanding our customer needs. And here we start with typically what you call a second opinion, right? Most people have some money and they would have bought an LIC policy. If you're my age, you would have bought some mutual funds, you would have bought some stocks, you might have some ULIPs, you might have some real estate, and you want a second opinion, right? Has my bank manager sold me the wrong thing? Is my portfolio well balanced? So we do something called a second opinion. We look at your money and give you a second opinion on that. We understand your attitude towards money, right? How much risk appetite do you have? We also understand your current circumstances, right? So how far are you from retirement? How many children do you have? And combine that with, some people want to live in Malabar Hill and some people are very happy in Malad, right? So it's a question of what drives your goals and aspirations. The real science, right, is actually in the next 4 steps. So what is the asset allocation for you? How much should be equity? How much should be fixed income? How much should be precious metals? Whatever the asset classes are. Within equity, how much should be large cap, mid cap, small cap as an example? Within large cap, right? As large cap funds are the top 100 companies in the country. And within that, which are the funds to buy, right? The reason we started Scripbox, and I'm just taking a story back, when we looked at it and we were targeting people who were just getting started, there were 5,000 mutual funds available in India you could invest in schemes. Of them, 800 were equity-linked schemes or equity schemes. In those 800 schemes, there were only 263 underlying stocks. So there were more formulations out of those stocks. And that's mind-boggling. But our belief is that up to 14 to 18 mutual funds are enough to give you diversification across multiple asset classes, right? So how do you decide where to put the money? So what does Scripbox do for this? Again, I was at Capital One, know a little bit of math, did lots of back testing. So for every asset class, we have a multivariable, multi-weight scorecard. We back test for assets, we back test for 40 years. For funds, we back test for 10 years. Again, we put all this into reasonably, again, I won't say AI models, but yeah, complex Excel/SPSS models. We look at return profiles. We take a long-term approach. We look at 1 year, 3 year, 5 year, 10 year returns, look at rolling returns. We look at lowering risk. And for us, lowering risk is actually not about the minimum risk. It's about the predictability of returns, right? That standard deviation I was showing you, the less volatility there is, the more predictable the return, right? So which mutual fund, which fund managers have provided that, which category has provided that. Then obviously the other is minimized drawdown. As I talked about, one of the largest sentiments is fear, right? If you see your portfolio, right, 50% down, 30%, it hurts you, right? How much ever I tell you, take a 20-year view, take a 10-year view, it hurts, right? So how do we minimize the dissonance? And obviously the risk to return ratio. There is obviously an elaborate analysis process. In the latest run, when we built our latest portfolios, we did something like 38,000 simulations. So it's not a couple of Excel spreadsheets. It is not to show off. This is basically the power of computing to make sure that what we are offering our customers makes logical sense. So we have, I mean, again, everything in between, but say as an example, 4 standard portfolios called active growth, where there's a blend of Indian equity, US equity, gold, and Indian fixed income. There's balanced growth, which has more Indian fixed income. And then there's obviously minimum growth, which is purely fixed income. Again, depending on if you need the money in 3 months from now and or 6 months from now, a year from now, we would tell you to put all your money in minimum growth, right? It's purely fixed income. Obviously, mutual funds are extremely tax efficient compared to other asset classes. So we're able to create a sort of purpose-specific back-tested portfolios. And why not 61% and why 59%? I think there is also investing is also about understanding. I should be able to explain it to you rather than confuse you. So we try to keep it as simple as possible, as far as possible. And not only that, I mean, we have been able to demonstrate that, let's say, like an active growth portfolio, where we rebalance your portfolio every year, the annualized returns are 13.5%, but the maximum drawdown or the return to risk is 1.5 times better than a single asset class. If you put all your money into equity versus taking an active growth portfolio, your returns are not much worse, but you sleep much easier at night, right? So it's basically figuring out what works for you and creating these multiple portfolios over time for you is what we do at Scripbox. In the interest of time, I will summarize. Investing for the long term is essential to beat inflation. Please, I mean, there is that old Maruti ad, no? The only thing we get asked is, kitna deti hai? Right? You'll show all these fancy slides and graphs, and all you get asked is, kitna deti hai? That's not the question to ask. Kafi deti hai. It's enough to make you sleep easy at night. Take advantage of the India story. So if anybody is dialing in from abroad, I'm a big fan of India. And I would highly recommend, it's a great great asset class to invest in. And you cannot, I mean, if you have to build a long-term portfolio, you have to have a blend of risk assets, some fixed income, some gold, some real estate, lots of equity over time. Have reasonable expectations. Don't check your portfolio every evening. Don't check your portfolio thrice a day, especially the portfolio which is long-term, right? If you're trading, which a lot of people do on a daily basis, that's very different. But if you're thinking about the college education, if you're thinking about your retirement corpus, have very reasonable and long-term expectation. What asset allocation does gives you a palatable investment journey, right? You're not seeing too much volatility. You're not seeing too many downsides. You might not see the most fantastic returns as your neighbor. As I said, one of the biggest destroyers of wealth is greed. One investor will tell you, hey, I did fantastically well, this stock did very well, and then you follow them tomorrow and it's not a great idea. Investing is a scientific process, and I can't overemphasize this. The number of times we hear about relationship managers moving from one bank to the next, or one manager to the next, and the customers moving with them, which to us makes no sense at all, right? Because the process is far greater than the person. And I say this as the founder and CEO of Scripbox. It doesn't matter what I know. What matters is what my system does, what my process has done. And I hope that we at Scripbox have been able to demonstrate an evidence-based, unbiased approach. So without making this about Scripbox, what I wanted to talk about today and demonstrate was that you have to be investing long-term. Asset classes behave very differently. And if you just combine all of this in a scientific process, it's very likely that you'll get great outcomes. I'll stop now and open to any questions. So I can see the chat window.
We have one question from Abhijit.
Yes.
What is the meaning of drawdown?
Drawdown is how negative the peak to the bottom. Sorry, drawdown means that how much pain will you see in one shot, right? So if you start at, say, the Sensex is at, or say the Nifty today is at 19,800, and it starts crashing, and it goes down all the way to, like happened in COVID, it goes down to, say, 8,000-9,000. That's a 50% drawdown, right? That's the pain which we want to avoid, especially in your fixed income portfolios, right? So a lot of people, like the Franklin Templeton fiasco happened, those are supposed to be fixed income portfolios. And they were taking a lot of credit risk. And when the bubble burst on the credit risk, there were serious drawdowns. So when you're taking interest rate risk or you're taking credit risk, those tend to cause a lot more pain. And we try to avoid that. Again, luckily for us, or our math didn't tell us, when the crisis happened for Franklin Templeton, we didn't have a single customer of ours with a single fund which was blacklisted or which was side pocketed.
Right. That's amazing to know. The next question for you is it wise to sell real estate investments after 50 plus age?
Depends on your situation and the return you're getting. It's very rarely a seller's market. It's always a buyer's market in the real estate. The reason we don't like real estate as an investment category, and it should be part of your portfolio. One, it's illiquid. Second, the cost of buying and selling is pretty high. And typically, I don't know the US, the India markets I can talk about, and they're reasonably non-transparent. So yes, if it's not your primary home, moving it to a more liquid, obviously taking care of your capital gains and in your tax, but it would be very wise to move your returns to more liquid investments, which you can manage and which you can control, and which are more transparent as compared to real estate.
Okay. The next question is, can you touch base on rebalancing the portfolio, and what are your thoughts to invest only in index funds alone?
Two fantastic questions. Rebalancing is basically what happens is that, see, fund management. So I'll give you an example, right? Now, the mid cap and small cap has seen a run up, right? It's not that they are bad asset classes, but there's a reversion to the mean at some point in time, right? So moving some money from, say, mid cap and small cap to large cap at this point in time, and there are well-defined rules which help you do that. So that helps you rebalance. What also happens is sometimes you get over-diversified, right? You end up with 20 funds, so bringing it down to, again, 14, or you get only 8. So again, diversifying. So rebalancing is basically making sure that your asset allocation is aligned to your goals. Another example would be equity markets run up, and suddenly they're 70% of your portfolio, and only 30% is in fixed income. It's good to book profits, move some back to fixed income, and continue again, because you're taking a 10-year journey. So the power of rebalancing in a systematic manner, obviously keeping tax efficiency in mind, is it aligns your asset allocation to your long-term goals. In terms of index funds, yes, for certain categories, yes, India still has enough alpha. So I would believe that given some of these markets like the mid-cap index or the small cap index are so illiquid, the tracking error is likely to be reasonably high. And I don't think there's enough value at this point in time to go passive completely. Having a blend of index funds and actively managed funds would be the right answer in my mind. Will it change in 10 years? Probably so. But I think there is enough merit in having a portfolio which includes regular funds, includes actively managed funds.
Thank you, Atul. It's a lot of questions, so I'm just going to pick. Please touch upon personal wealth management services by investment companies such as Geojit. I don't know if it's not in context with we can skip.
I don't know them very well. They're also a good wealth manager. It is not in my space to comment good, bad on somebody in the same space. I am sure they do a good job. Yeah, that's my only answer.
I think the next question is interesting. What is a checklist I should follow to identify a good investment advisor?
Name should be Atul Shinghal. No, jokes apart, they should have a well-defined process, demonstrated success on that process, and the gumption that they will stay with that process. Right? There is no one size fit. There is no right answer. It's about the process of the investment advisor. Are their interests aligned to yours? Do they have a demonstrated track record? Do they have a process which is transparent and repeatable and scalable and is not dependent on one person? As I said, I mean, one of the things we did over the last 2 years is acquired about 7, 8 fantastic financial advisors. And the reason they joined us together was to bring the power of collective knowledge in one place and to build repeatable processes. Because what happens is a one-man, two-man shop. While you might be excellent individually, gathering all this knowledge in one place is extremely difficult. So find somebody, follow an institution which follows process, is scalable, has a demonstrated track record, and is available to you and is going to be around for the next 100 years, right? I think it's important. See, wealth is multi-generational. Remember, wealth is multi-generational. So pick somebody who's going to be around for the long term.
Atul, on that note, since you mentioned, someone has asked, how do we contact you?
Download the app. No, sorry. Yeah. So I'm available at Atul_Shinghal@Scripbox.com. I'll send out an email with my contact details to everybody who attended. Welcome to reach out. Obviously, we are available at help@Scripbox.com. So one of the unique things about a digital player, we actually run our contact center 7 days a week. You can call us anytime. We have physical offices now in 7 locations. We'd be very, very happy to. On that note, I'm going to stop the questions for a minute and come back. So I have a request, right? I am an IIT alumni, and hence I can make this request to you. I'm here to build a 100-day institution. We are 10 years into it. We want to build something which stands the test of time. God has been kind. We've grown very well. We're in the top 10 non-banking wealth managers in the country, across people like Anand Rathi and ASK and everybody else who are much bigger. We serve about 85,000 families today. Our mission is to serve 1 million families. Right? Our job would be only well done if there are 1 million people who sleep easy at night, who believe their money is well managed, who believe that their interests are protected. And for that, I'm going to put up this little, if you want, you can download the app. Can everybody see it now? Is it visible, Nishani?
Yes, it is. It is.
So I'm now requesting. So this is my request. As I've answered questions. Can I request you to please download so that people can give me credit that Atul can actually sell something. He's a decent sales guy. No, that jokes apart. I really, really believe at the bottom of my heart that we do an honest, decent job, and we'd love to manage your money. How for PMS, and I'm answering some questions for PMS in equity. Please do humor me. Download the app, install it. And hopefully you'll invest through it. I'm not going to insist you invest, but I do insist that you download the app, give us feedback. What does it feel like? For PMS in equity via Scripbox, is it directly through stock or is it through equity mutual funds? It's both. We just doubling down on PMS as a strategy. PMS, for people who don't know, is a portfolio manager service business. Minimum investment is 50 lakhs. We manage about 700, 800 crores on that. We are our lead business leader is here today, Rinju Ibrahim. We're doubling on that. We do multiple strategies. We do pure equity. We do direct mutual funds, in equity. We do multi-asset portfolios. Again, there's no one size fits all depending on what you're trying to achieve. Is what you're trying to do.
Atul, there is one very interesting question, and I think that's going to resonate with many of us. What's your take on participatory investment plans like HDFC, Sanchaya Par, and Tata's plans, and as compared to the other investment options?
It'll be amiss of me to say this, but investing and insurance are very, very different fields. Don't confuse the two. Insurance is for life protection. So take a term life insurance. Leave the investment to investing professionals. I'm sure some of my friends in the insurance industry will believe that they do a great job. I ran an insurance company in South Africa, Old Mutual. They're very different practices. Asset management is about long-term asset management, whereas insurance is a very different purpose. I would say horses for courses. If you want your money managed, manage it through investment managers or wealth managers through the mutual fund industry.
Thank you.
A classical question, how to take a call on exiting long-term mutual fund, especially one which has been underperforming benchmark for 3+ years. It's a very difficult answer here because depending on the fund itself, right? Why is it underperformed? Has it underperformed relative to its benchmark or to your expectations or to whatever it is? The decision you have to take every time you look at your portfolio, obviously keeping tax in mind, is if I had that 100 rupees today, whatever the value of that, where would I put the money? If your answer is it'll be in a different asset class or a different product, do that. Right. So this loss aversion that, oh no, it'll come back, then I will sell, is a bad idea. The idea is, what would I do today? Right? Like I come from a credit card industry or a credit industry. The decision you take at that point in time is, will I give this guy credit or not? Similarly, will I make this investment? If I had this 100 rupees to invest, what is the best place of investing this money? Similarly, in a fund which you believe you want to get out of, don't try to time it. When you feel that this is not performing or your advisor is telling you this is a bad time to remain in this, get out and buy something else, obviously keeping tax and exit loads and all in mind. How are we doing for time, Nishani?
We have 5 minutes to go. 5 more minutes if you want to answer more
what
questions.
What are Scripbox charges on PMS? Paul, I'll drop you a line. Rinju, you can correct me. We don't charge any management fee. We take a hurdle rate of 8%, and then beyond that, we take a profit participation. But we can send you a note on this one. Interests are completely aligned. This is watershed, right? If in 2 years I don't perform, then 2 years I don't get paid. Would you recommend T-bills? Depends again. Yeah, I would. Depends, India or abroad. What is the purpose? Why are you saving in it? It's a good time to be taking some exposure to some of the fixed income products with the way the interest rates are. Somebody from Devalak.
How OCI customers can invest in India via Scripbox?
Yes, they can. So PMS is the route to go. What we did was we actually operate under 3 licenses. We run a mutual fund distribution business, which is what a lot of our business is about. We have a PMS, which obviously allows US investors to invest. And we have an RIA practice, a registered investment advisory practice, where we take a fee from the customer. We don't get commission from the manufacturers. We can definitely, you can invest through Scripbox. Absolutely. A large number of our customers are based abroad. There are restrictions. You can't do lots of mutual funds, but I think PMS would be the right answer for somebody to come into from abroad. And obviously, there are other asset classes we can help create a portfolio for you to take exposure to India without taking undue risk.
Okay. I think there's another interesting question from Selvam. Maybe this can be the last question. What is the minimum corpus that you look forward to from a customer?
Very proud to say that we've got customers from 50,000 rupees to 500 crores and everything in between. So we have no minimums. I started this company so that people with 5,000 rupees could start investing, and we remain committed to that cause. We don't charge you anything extra. We don't make it easier or cheaper. It's just you get started. You download the app. I'm hoping you can, and make your first investment. We have no more. I think in the interest of time, it's a Friday evening or a Friday morning my email ID, absolutely. It's Atul_Shinghal@scripbox.com. Please feel free to write to me. Know that your demat account can work, but we largely mutual funds. You don't need a demat account. You can start as it is. Download the app. What do you think of the market in next 6 months? Do you advise waiting for election results to invest? This is the question I was trying to avoid as much as possible. I have no idea. I have no idea. I think any time is a great. What else will you do with your money is my limited point. So what I would recommend to somebody who's nervous about the markets is a product called a smart transfer plan. So you start your money in liquids. Say you got 10 lakhs to invest. You put 10 lakhs into a liquid fund today. And over the next 12 months, you average cost it, right? You put a lakh every month, right? So you take advantage of the lows and the highs and everything else. So there are solutions available for everything. Don't let volatility scare you, right? You don't know what's going to happen after elections. You don't know who's going to win. So my view on this is don't wait. If you got money to invest, don't keep it under the mattress. Invest it now.
Thank you, Atul. Wonderful. That was
there are lots of very specific questions,
yes.
and I apologize. I am not the expert. I've got a strong research team. I've got great people on the team. Please, somebody, if I can request Rajesh or Rakesh or somebody to just keep the questions or share my email ID. We'll get back to each person. And again, I'll stop sharing. So I hope you did download the app, everybody. And I hope this session was of some value. I would love some feedback in the chat column if you found any value in it. I apologize for wasting your time on a Friday. And thank you for very much for the opportunity to interact with so many of the alumni. It's been a pleasure. Would love to come back and talk about asset classes, talk about entrepreneurship. My pet hobby is actually building businesses. So if anybody's got lessons around classes, wants to talk about how to build a business, how to think long term, would love to interact with people. I think it'll be great for me to talk to the alumni. So thank you very much for your time.
Thank you, Atul. That was a lovely session. Can you stop sharing your screen if you don't mind?
I have stopped actually, so I don't know. Maybe
whose screen is this, Rakesh?
This is somebody else's screen. Yeah.
Right. So thank you so much, Atul. That was lovely having you here with us. Very interesting topic, very interesting insights. I think everyone had a lot of takebacks and amazing questions. The constant flow of questions is that everyone is so curious to get to know all of these answers from you. And, we've had people still ask for your email address and lots of thank yous on the chat as well. But this was a fantastic session, Atul. I love the way you started your introduction with a lot of humor. I felt like a real person. Others, some of IITians are kept on another par. But thank you so much. This was lovely. I look forward to meeting you in person sometime soon and look forward to doing another session with you as well. Thank you to the audience. You were great. We had 150 participants today, which is a great number for us. And I hope we could add some value to all of you. Thank you and good night to everybody.
Have a lovely day, a lovely weekend. Thanks, everyone, and good night. Yeah. Thanks Nishani. Thanks, Neha.
Bye-bye. Thanks, Atul. Thank you so much. Bye-bye.